All right, let's talk about one of the most powerful tools in finance, the balance sheet. It's basically a company's financial X-ray, a snapshot of everything it owns and owes at one specific moment. And today, we're going to decode it.
You know, earnings can be played with, cash flow can be shifted around, but the balance sheet, that's where the financial reality hits. If you really want to find the truth about a company's health and even its strategy, this is where you have to start.
And here's the one unbreakable rule that holds it all together. Assets, which is what a company owns, must always equal its liabilities, what it owes, plus the equity that belongs to the owners. This isn't just a theory, it's an accounting law. Get this down, and everything else just falls into place.
Okay, so let's start with the first piece of that equation, assets. These are simply the resources a company has to work with to make money. We usually break them down into two main types. Current assets, which are things that can be turned into cash pretty quickly, say within a year, and non-current assets, which are the long-term stuff.
And you can learn so much just from a single line item. I mean, look at this. At Walmart, over 70% of its current assets are just stuff on shelves, inventory. But then you look at Apple, and it's less than 4%. This tells you a totally fascinating story about two completely different ways of doing business. Walmart is a logistics giant, a master of the warehouse. Apple, on the other hand, is all about that super efficient build-to-order model.
Right, but what about the assets you can't physically touch? Not everything is inventory or a factory. Some of the biggest assets are intangible, and a really interesting one is called goodwill. Now, this only shows up on a balance sheet when one company buys another one for more than it's worth on paper. And this one little metric, goodwill, can reveal a company's entire growth strategy. Take a look at Costco, zero goodwill. Just like Apple, it grew organically, building everything from scratch. But then you see Johnson & Johnson, where almost a quarter of their entire asset base is from goodwill. That tells you right away that they grow by buying other companies. It's a growth by acquisition strategy, which is a whole different ballgame with its own risks.
Okay, now for the other side of that core equation, liabilities. This is pretty straightforward. It's just all the company's financial obligations, everything it owes to its suppliers, to banks, to investors. In short, it's the company's debt.
So when we talk about debt, what really matters is a metric called net debt. It's simple. You take all the debt a company has, and then you subtract all its cash. What's left over is the real debt burden. And check this out. Companies like Costco and Nvidia actually have negative net debt. That means they have so much cash on hand, they could pay off every single dollar they owe today and still have billions left over. I mean, that is an unbelievably strong financial position.
Now, let's flip the script completely. This number, 7.23x, belongs to Home Depot. It's their net debt to EBITDA ratio. Now, EBITDA is basically a rough estimate of a company's yearly cash flow. So what this number is telling us is that it would take Home Depot over 7 years of its cash flow just to pay off its net debt. So is that bad? Well, not necessarily. It's actually a very deliberate strategy. Home Depot uses debt, what we call leverage, to fuel its growth and pay shareholders, which means they're taking on more risk for what they hope are higher returns. And that brings us to the final piece of our puzzle, equity. It's really simple. You take all the assets, subtract all the liabilities, and whatever's left over, that belongs to the shareholders. We call it the company's book value. Okay, but this is where things can get a little weird. Let's take Starbucks. If you look at their balance sheet, they have negative equity of over $8 billion. Wait a minute. On paper, that means their liabilities are bigger than their assets. So how is a company that popular not completely bankrupt?
Well, here's the secret. It's not a sign of trouble at all. It's actually the result of a very intentional choice. For years and years, Starbucks has used its huge profits to buy back its own stock. When a company does that, it actually reduces the equity on the balance sheet. They've just bought back so much of their stock that it's pushed their book value into negative territory. It's a sign of a company that's been sending massive value back to its owners.
So, now that we've got the three core pieces, assets, liabilities, and equity, how do we actually put it all together and make sense of it? Because it's not just about knowing the definitions, it's about asking the right questions to understand the story the numbers are telling. And this right here is the key takeaway, a simple 5-question framework you can use for any company. 1. Can it pay its bills that are due soon? 2. Is its debt under control? 3. Are the assets it lists actually valuable, or is it just accounting fluff? 4. What is it investing in for the future? And 5. Is the value for the owners going up or down? If you can answer these 5 questions, you can understand any balance sheet.
And this table really brings it all home. When you look at a few key ratios, you can see these completely different stories emerge. NVIDIA is a fortress, with almost no debt. Apple is, well, it's pretty balanced. And Home Depot is highly leveraged, using debt as a tool to grow. See? None of these is necessarily right or wrong. They're just different strategies, different stories being told by the numbers on the balance sheet.
By the way, the data and the framework for this whole analysis comes from the great folks over at FinStill, and that's pronounced F-I-N still. They build some absolutely incredible tools for digging into company fundamentals like this.
So if you found this helpful, definitely follow us for more explainers just like it. And if you want to put this stuff into practice, head on over to fffinstill.com. They've got over 300 free learning concepts and all the tools you need to analyze any company's balance sheet for yourself.
So now you have the tools. Next time you're looking at a company you're interested in, pull up its balance sheet and just ask those 5 questions. What story is it telling you? Is it a fortress? Is it a high wire act? The answer is right there, waiting for you in the numbers.